Dustin, good to see you. I'm excited today because we get to do a deep dive into designing a risk appropriate financial plan. Every investor, of course, is different. We all have unique financial goals, but I want to understand how you determine a client's risk tolerance because I can't imagine many investors asking you to build a risky financial plan.
Yeah. There's an art and a science to helping any client determine their appropriate exposure to risk. But I really specialize in risk managed investing. So I don't tend to take on many clients who have large appetites for risk.
Mm. And what I want to remind everybody watching is that working with you means working with a team of investment experts at Brookstone Capital Management who implement those risk managed portfolios. Explain that.
Certainly, there's a lot of intelligence and due diligence that goes
Yeah.
on behind the scenes in our portfolio construction. We work with a seasoned investment team at Brookstone. That team's got decades of experience. Currently, they oversee the investment of more than $8 billion in client assets, and they design many of the strategies that I use in my clients' portfolios.
Mhm. And that team, of course, is led by Chief Investment Officer Mark DiOrio, who joins us now. Mark, hello.
Hi, Aaron. Hi, Dustin.
So, Mark, I just want to start with that. As Dustin mentioned, Brookstone manages about $8 billion. That allows Brookstone investors like Dustin's clients to access some advanced investing opportunities and strategies. Can you explain that process?
Sure. If you want to know in one sentence, what we try to do is provide institutional quality portfolios or strategies at low minimums or built for individual investors. But to peel back the curtain a little bit to give you an idea of the investment process, it's really composed of three factors. We have an investment committee, an investment platform, and then the end investment advisor. And so the investment committee, as Dustin mentioned, is built with a seasoned team. So each of the members have 20 years investment industry experience. And then we rely on a lot of internal and external market research sources to really help inform, set, and guide portfolio decision making. And essentially, what the committee also does is oversee and manage an investment platform. And so that investment platform encompasses all types of different investment strategies. Some you may not have heard of, some you may be very well familiar with. But what we're trying to do is put together a nice roster of diverse strategies, diverse investment thought to really build that custom portfolio for the individual investor. And then from there, we are essentially an extension of Dustin's practice, where we work directly with Dustin as the investment advisor to help narrow down and identify what's the appropriate risk and return objectives of the individual client, and where Dustin takes it from there and decides which portfolios would make sense in collaboration with us, but he's also working individually one-on-one with that individual client.
Mm-hmm.
Yeah, and Mark, we not only build those portfolios for clients with custom and institutional investments, but we typically try to include multiple investment strategies. Can you explain why that strategy diversification is so important?
Sure. If we go back many, many years, kind of the evolution of investment management, it started with two major asset classes, stocks or bonds. And the idea is stocks for growth, bonds for income. And as we've gone on, we've seen many changes in interest rates over the years to from high levels to very, very low interest rate levels. And then also the equity universe has really expanded as the economy has become much, much more diversified. And then take it a one step further, where maybe in the 1980s and 90s, there were mutual funds and retirement plans. You got broad diversification. Today, the markets have become more and more advanced, where you can identify specific strategies that have differing risk and return characteristics. And Aaron, I noticed you put this slide up, which shows quarterly strategy performance for different types of equity or stock strategies. And what it looks at, each color there is a type of strategy. So a growth strategy, a high dividend strategy, high beta strategy, low volatility. These are all just different ways to approach the equity markets. But what you notice there is that the different colored blocks, they change from quarter to quarter. And the top shows the best performing strategy for that quarter, and then all the way down to the lowest performing for that quarter. the point here is that different stocks outperform during different times and vice versa can underperform during different times. But the idea is as you combine these strategies, you really smooth out the return profile and you get exposures to different parts of the market. And I think that's really a major benefit where you didn't have this level of diversification or access to this many strategies really previous to the last, as this has been developing over the last 10 years, as more and more strategies have become available. And we've been able to research and decide what really is appropriate for individual investors and what can, after spending some time on the research side, what can really come on the platform that we're confident with.
Mm. It's interesting. It's definitely a moving target. So, Dustin, those investing opportunities and strategies become even more important, of course, as we approach retirement. Explain your risk managed approach and how it's different from, like Mark had said in the very beginning, buying more or less bonds.
Yeah, most investors understand that they need to invest in multiple asset classes, multiple types of assets. But it's really important to remember that a diversified portfolio of stocks and bonds oftentimes will only include one investment strategy. So, for the reasons Mark mentioned, when we build these portfolios, we include multiple investment strategies. Each one of those investment strategies may have its own methodology for capturing returns. And more importantly, each one of those investment strategies will typically have its own methodology for defending against large investment drawdowns.
Mhm.
And then when I build portfolios for clients, I'll typically try to include some investment strategies that transfer risk away from the client to other investors or other institutions.
Mhm. So, let's drill down then into some of those specifics. What are some specific strategies that you're recommending?
Yeah, just as some examples, not necessarily something we'd use with every client, but so some of my clients' stock investments are hedged. So we'll use defensive put options to allow an investor to stay invested in stocks, but do it in a way that's less volatile. That'd be an example of how we might seek to transfer investment risk from our client to other investors, the investors writing those options. Another example would be structured notes. Those are custom instruments issued by large banks, and they come with contractual terms. Mark and his team at Brookstone, each month they negotiate those custom notes and custom terms for our clients. And with those notes, one of the things we can do in some cases is provide various levels of principal protection at different market positions. So that's an example of how we might transfer investment risk from our client to an institution like a bank. And then you can look at something like insurance products. Those are something that we offer our clients outside of Brookstone. But with certain insurance products, we can guarantee a portion of the client's principal or guarantee a portion of their retirement income. Again, transferring some of the investment risk or other risk from the client to an institution, in this case, an insurance company.
Okay. And Mark, last question is for you. Why would this risk managed approach be particularly attractive to investors as they approach retirement?
Sure. There's two main risks facing an investor. One, inflation, and two,
Mhm.
volatility. And so the inflation risk is simply that the reason to build an investment portfolio is to preserve your principal or purchasing power over time and also grow that purchasing power over time. And you don't know what the inflation level is going to be year in, year out. You just know that it is going to be part of the retirement landscape as you go forward. So you don't want to be too conservative with your investments. On the flip side, if you're more aggressive, you see more volatility, so you risk what's called sequence of returns risk, meaning that, well, you may hit a challenging market environment while you're withdrawing funds, and that can start to deplete the funds in your account and the longevity or endurance of the portfolio. So when we're building the portfolio and using multiple investment strategies, we're looking at trying to build an enduring portfolio that can manage through the ups and downs and outpace inflation over time. And so this chart just really demonstrates that when you add diversification components to the portfolio, you don't get the big volatility of the equity market, but you don't get the low returns of necessarily the fixed income or bond components of the market. You kind of get a blend of the two, which gives you a more or a smoother investment path, which allows you to take withdrawals really for an extended period of time, giving us an enduring portfolio over a long period of time.
Mhm. I think that this is really interesting to kind of take a peek under the hood and see how the sausage is made. It's very interesting. Dustin, if somebody has any questions about designing their own unique risk appropriate financial plan, what's the best way to reach you?
They can send me a text at 830-476-2505 or reach out on the website to book a free chat at longlivemymoney.com.
All right. Dustin, Mark, thank you both.
Thanks so much.
Thank you.